Genomics is a multi-trillion-dollar opportunity. That is the exact statement from Cathie Wood. Elon Musk backed it up, stating you can basically do anything with synthetic RNA and DNA. He called it a computer program that is fundamentally disruptive. This isn't science fiction anymore. We're talking about editing human DNA, curing genetic diseases, and rewriting the code. If biology is the next software and this is the next AI boom, getting in early could be the ultimate wealth multiplier. And you don't need a medical degree to invest in it. Wall Street has already packaged this megatrend into targeted ETFs. But to understand the financial risk, you have to understand the science first. For the last 100 years, the pharmaceutical business model has been about treating symptoms. You take a pill every day to manage a condition. It is a subscription model. Genomics completely breaks that model. It is the science of mapping, reading, and editing human DNA. These companies use technologies like CRISPR to act as molecular scissors. They don't manage the disease. They find the broken code, cut it out, and cure it at the source. From an investing standpoint, this is the holy grail. If a biotech firm patents a genetic cure, they lock in an absolute monopoly. The profit margins are astronomical. But you cannot just buy one genomic stock and hope they survive. You need a basket. And there are two ways to build it: the active approach or the passive approach. The ARKG Genomic Revolution Fund represents the active approach. This fund relies on Cathie Wood's team of analysts to hand-pick the companies mapping the brain and curing cancer. You are buying a highly concentrated portfolio of 33 companies, with the top 10 making up 59% of the fund. This includes names like Twist Bioscience, CRISPR Therapeutics, and Tempus AI. These are actually my personal favorites in this theme. It launched in 2014, and because it requires active scientific research, it charges a premium expense ratio of 0.75%. It pays 0 dividends. TipRank's top analysts rate it a moderate buy with about 54% upside over the next 12 months. On the other side, we have the passive approach. The Global X Genomics and Biotechnology Fund. This fund strips out human emotion and tracks a strict index. It holds a slightly broader basket of 49 companies. The top 10 make up 52% of the weight, featuring heavyweights like Moderna, Arrowhead, and Praxis Medicines. It launched in 2019 and charges a lower expense ratio of 0.5%. It does pay a small semi-annual dividend yielding 1.39%, with a 5-year dividend growth CAGR of around 36%. And just like ARK, the analysts love it. TipRank's top analysts give it a moderate buy, projecting nearly 58% upside over the next year. What if you think about buying both funds? The overlap by weight is 32%. They share 17 companies like Illumina, Natera, and Guardant Health. Normally on this channel, we run a 20-year simulation. But we are not doing that today. Simulating a 20-year horizon on a medical technology that is still in its absolute infancy is, well, it's just guessing. We rely on data, not crystal balls. Instead, look at the historical price chart since 2019. This tells you everything you need to know about the risk. Look at the massive spike in 2020. ARKG shot up over 200% during the cheap money tech bubble. But look at the crash. Both funds bled out completely, wiping out all those gains to sit in negative territory today. This brutal volatility is exactly why Morningstar slaps both of these funds with a 1-star rating. The verdict. This is not a core portfolio holding. This is high-stakes venture capital. If the science fails or interest rates stay high, these companies burn cash and collapse. But if they successfully cure genetic diseases, the upside is completely uncapped. So, Would you allocate a small piece of your portfolio to the genomic revolution? I left a link to the MoneySketch tool in the description if you want to stress test your numbers. Thank you for watching.